So, you see the headlines all the time, right? A company has a good quarter. But what does that actually mean? Today, we're going to pop the hood on O'Reilly Automotive's latest earnings report and really see what's making this engine run so smoothly.
All right, first things first, let's set the stage. O'Reilly is not some new kid on the block. We're talking about a heavyweight in the auto parts game, around since 1957. And their latest report? Well, it shows they are absolutely firing on all cylinders, which is pretty much business as usual for them.
Okay, let's get right into the numbers that matter. First up, sales at their existing stores, the ones open at least a year, shot up by a super healthy 5.6%. Now, for any retailer, this number is huge. It shows the core business is growing all on its own.
And all that strong selling, it flowed right down to their profits. The company's operating income, that's basically the profit they make from their day-to-day business of selling parts, jumped by a really solid 9%.
And here it is. This is the number that really gets investors paying attention. Earnings per share, up 12%. That's a big beat over what Wall Street was expecting. So the big question is, how on earth did they pull this off? Let's dive in.
All right, here's how we're going to break it all down. We'll start with what fueled this strong quarter. Then we'll look at their growth engine, follow the money trail, see how they're investing in themselves, and finally, take a peek at what's coming up next.
So, the numbers are impressive for sure. But what's the story behind the numbers? How did the company's leadership frame this performance?
Well, if you ask the CEO, Brad Beckham, it all boils down to one thing: customer service. He gives 100% of the credit to his 93,000 team members for just delivering an experience that keeps people coming back.
Okay, so great customer service drives results. That makes sense. But how do you turn that into a reliable growth machine that delivers year in and year out?
Well, they have this powerful two-pronged attack that's simple but just incredibly effective. On one hand, they squeeze more sales out of their existing stores. On the other hand, they are aggressively opening brand new locations.
Now that first part, comp sales as it's known, is like taking the vital signs of a retailer. It tells you how healthy the main business is without all the noise from new store openings. And as we just saw, O'Reilly's pulse is very, very strong.
And this is just brilliant. Look at this. Their customer base is almost perfectly split down the middle between the do-it-yourself folks working in their own garage and the professional mechanics. This is a massive strength. It means if one side of the business slows down, the other can pick up the slack. It's an amazing balance.
And they just keep on expanding their turf. That second part of the growth engine is always churning. As of the end of the quarter, they're running over 6,500 stores all across North America.
So, here's the crucial part. How does all this activity, all these sales from thousands of stores, actually turn into cold, hard profit for the company? Let's follow the money.
This chart does a fantastic job of showing you the journey. They start with a whopping $4.7 billion in sales. After they pay for the parts themselves, they've got about $2.4 billion left. Then, after paying for rent, salaries, all that stuff, they're still sitting on almost $1 billion. And at the very end of the day, they walk away with over $726 million in pure profit. And remember, that's just for one quarter. It's a testament to how efficient this whole operation is.
So, what does a company like O'Reilly do with all that cash? Well, a massive part of their playbook involves making a really big bet on themselves.
They do this through something called a share repurchase program. Basically, they take their profits and go out onto the open market and buy their own stock. This reduces the number of shares floating around, which tends to push up the value of each share that's left. It's a direct way to reward shareholders.
And we are not talking about a small program here. The sheer scale of O'Reilly's commitment to this is, well, it's staggering. Since this program kicked off in 2011, they've poured nearly $27 billion into buying back their own stock. That is a massive, long-term vote of confidence in their own business.
So when you put it all together, strong sales, incredible efficiency, and huge returns to shareholders, it gives a company a whole lot of confidence. So let's look down the road and see what they're expecting for the rest of the year.
Because this quarter was so strong, the company did something that always makes investors happy. They officially raised their financial forecast, their guidance, for the entire year. It's one of the clearest signals a company can send that they think the good times are going to keep rolling.
And here are those new numbers. They're now expecting revenue to be as high as $17.8 billion for the year. They see that all-important comp store sales growth staying strong between 4 and 5%, and they've bumped up their earnings per share forecast too. It's all pointing up. So this leaves us with a really interesting final thought. We know the average car on the road is getting older, which should mean more repairs. But at the same time, new cars are basically rolling computers, way too complex for a lot of weekend warriors. So the question is O'Reilly's perfectly balanced model, serving both the pros and the DIY crowd, the secret sauce that makes their business built to last? Based on these numbers, it sure looks like they've got the answer.